Welcome to Get Rich Education. I'm your host, Keith Weinhold. The richest people have the most debt, and you can actually boast of having a lot of debt too when you understand it well. Who are some of the biggest celebrity mortgage debtors? What can you learn from them? And under exactly what circumstances is debt good? And what are the risks? Today on Get Rich Education. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com. You know, starting in real estate seems hard for some. Even experienced investors can find it difficult to achieve the success that they had hoped for. What if there was one small change everyone could make that would solve these challenges? Allie Boone offers a book that really no one else has. It's an easy-to-understand glimpse into the real estate investing industry and your mindset. It's life lessons on hacking your mind before you hack your wallet. Her book to grab on Amazon is called Not Your How-To Guide to Real Estate Investing.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Here it is. Hey, welcome in to GRE. I am your host, and my name is Keith Weinhold. Last year, I was at my high school class reunion in Pennsylvania, and I got talking to a classmate that I hadn't seen in quite a long time. She knows about me and knows I'm an avid real estate investor. She happened to mention to me that she and her husband have a rental property in York County, Pennsylvania. And at one point she mentioned that the rental property is paid off. And it was at that point that I asked her, after she told me it was paid off, if she and her husband could go back and get another loan on the property again. I was basically asking if it was financeable. She responded by giving me the strangest look that, without saying it, she basically looked and asked and wondered why in the heck she would ever get a loan on her property if it were already in a paid-off position. Well, leverage and opportunity cost would be my short answer there. See, savvier people, wealthy people, and financiers understand that it makes little sense to have so much money tied up in their own home or any one property when they could make a greater return on that money elsewhere than the paltry interest rate charges that one has the benefit of paying today. The richest people have the most debt. Facebook founder Mark Zuckerberg and his wife could buy dozens or hundreds of multi-million-dollar homes, all cash, but yet when it came time for them to buy their first home together, they bought a home in California, just about 3 miles from Facebook headquarters. They applied for, qualified for, and secured a 30-year loan for their home. Now, maybe you feel like you wouldn't do that because you feel like you don't have the opportunities that Zuck does. Well, the more you look around and ask questions and learn, the more opportunities you have that you didn't think you did. And you don't even need that great of an opportunity. You just need to beat the mortgage interest rate on the property value that you're basically borrowing against. Elon Musk of Tesla and SpaceX has been running neck and neck with fellow mega billionaire Jeff Bezos as the world's wealthiest person. But just last year, Elon Musk took out $61 million in mortgages to buy up 5 California homes. And by the way, his monthly payments, that just must feel like flipping a penny into a fountain, because Elon Musk's net worth is estimated between $100 and $200 billion today. Then there's Meghan Markle and Prince Harry. You might have heard that Meghan and the Prince landed in a nearly $15 million home in Santa Barbara, California, and reportedly the former royals obtained a $9 million mortgage for their new digs. And I'd say, hey, did you even get enough debt there, Meghan Markle and Prince Harry? That looks like a 40% down payment and only about 60% loan to value there, Prince. If they got a 30-year loan, by the way, we're talking monthly payments of around $50,000. How about Beyonce and Jay-Z? They've been known to borrow tens of millions of dollars for luxury home purchases. Public records show that the couple financed their $88 million mansion in Bel Air with a $53 million mortgage from Goldman Sachs. That's per the Wall Street Journal. Chrissy Teigen and John Legend, they've been married 8 years. After selling their previous pad, the model and musician recently upsized to a Beverly Hills home for $17.5 million, and they confirmed through Twitter that they are indeed making payments on their California home. But it doesn't always go well. Remember, if you borrow at that low rate, you need to be responsible and invest at a higher rate and be able to service your debt, because take Charlie Sheen. You've still got to make your monthly mortgage payments, Charlie, even if you're a famous celebrity. Sheen sold his Beverly Hills mansion for a big loss 2 years after facing foreclosure for reportedly owing more than $80,000 in back mortgage payments. Yeah, the actor was reportedly forced to lower the asking price 5 times before it finally sold. Now, most of those celebrities that are apparently making arbitrage plays there, meaning borrowing at a lower rate and investing at a higher rate, they aren't even known as business people. They aren't known for having financial savvy, yet they apparently got some good advice. And what about me, my own debt? I have had millions of dollars in mortgage debt from a young age. I have long possessed the ability to pay it off and still do, but see, doing so wouldn't make any sense. For every $1 million of debt at, say, a 3% inflation rate, it's not just about how I get to pay back the bank with debased dollars, therefore creating a $30K tailwind annually for me on every $1 million borrowed. You got to understand that that right there is small potatoes. The big benefit is the leverage. Leverage doesn't just destroy puny compound interest. It's a substantially greater wealth generator than the inflation profiting benefit on the long-term fixed interest rate debt. So this strategy is not reserved only for celebrities. You can do it too, although probably at a smaller scale than the celebrities are. Now, when is debt good anyway? Let's talk about some of the ways to identify good debt. First, if it is secured with good collateral, that is really good. And that's why a bank is willing to make a loan to you on real estate in the first place, because its value is undeniable since it houses people and its value stays stable. Secondly, your debt is a screaming good deal when, like I say, the payments are completely outsourced to a tenant like they are in a cash flowing rental. And thirdly, debt is good when you have a low mortgage interest rate. That way it's easier to create a spread with arbitrage by borrowing at that lower rate and investing at a higher rate. As sweet as that is right now, one can make the case that mortgage interest rates are lower than inflation. And the way exactly that you benefit when your rate is lower than inflation is that you are paying back the bank with dollars that get debased even faster than the bank's interest charges can accrue on you. You are winning. You're winning more than Charlie Sheen. Then if you're not sure that your mortgage interest rate is lower than inflation, consider that your mortgage interest is often tax deductible and now you've got more of a spread. Now, even if your debt were not outsourced and you had to pay that debt yourself, you're still winning when that mortgage interest rate is lower than the rate of inflation. But when it's outsourced in a cash flowing rental, it really puts this exclamation point on it being a good deal for you. Now, that is when debt is good to you. But consider that often when you're taking out a mortgage loan, how does the bank, your partner in this transaction, now how do they see it? How do they see it as good debt? Your bank, also known as your lien holder, is going to require that you be insured. That way it lowers their risk. You must be insured when you've got a lien on the property. Understand that when you make an improvement to your property, whether that's your primary residence or a rental, what you've done is you have just improved the quality of the bank's collateral. Yeah, banks love when you improve your property for that reason. In fact, they'll often let you take a loan against your property with those improvements included for up to 80% loan to value primary or 70-75% loan to value for a rental. And when you do this cash out refinance, It is a tax-free event for you. Yeah, because the IRS classifies debt as tax exempt, and you still get to hold on to the property even with the tax-free cash in your pocket and a higher leverage ratio, although you're probably going to have lower cash flow with the new debt structure. But gosh, talk about some good debt. So it is exactly these understandings that make you a master of debt, not a servant to debt. Because see, for most people, a mortgage is actually painful, but for the financially educated, it is a money-making tool. The more you're leveraged, the more you can use your money to invest. The same strategy works for you, just like it does celebrities, but only at a different scale. If you've got $5 million in debt, well then that's probably a wealth marker. Yeah, a wealth marker, because you must be pretty creditworthy and have a lot of assets in order to even get that much debt. You might then have, say, $12 million in assets with that $5 million in debt, the difference being your net worth of $7 million. That's why, say, $5 million in debt, if that's all you know about a person's finances, that probably means that that person is actually pretty well off. A risk to the real estate investor is becoming overleveraged. That means you've taken on more debt than you and your tenants can service, or another way to say that is too much negative cash flow. Today, our guest and I are going to talk about what it takes to get more debt the right way, the responsible way. He lives in Southern California, and he actually has celebrity clients, but he also knows how to help everyday people with something as simple as boosting their credit score 20 points so that you can qualify for a mortgage. So we're really talking about where you as an investor and you as a consumer intersect with our content today. Now, on previous episodes here with Ridge Lending Group President Charlie Ridge, we've talked about what minimums it takes for you to qualify for an investment property in regard to your credit score and your DTI and your reserve amounts. But we'll discuss what you actually need to do today to improve those metrics. The higher your credit score is, the better loan terms that you get, of course. And the last time I checked, a 740 FICO credit score is the highest score that helps you. Anything above that really doesn't help you get better terms. Wait until we discuss how high the average credit score for a mortgage borrower is today. It's almost mind-blowing. When it comes to how to actually get a high credit score, almost 2/3 of your FICO score today, 65%, is made up of two criteria: having a timely payment history and on your amounts owed. If you get those two things right, you've probably got a good score. The wealthiest people have the most debt. We're talking about how you can responsibly get into more good debt. Straight ahead, I'm Keith Weinhold. This is Get Rich Education. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the #1 lender for beginners and veterans. Start your pre-qualification, chat with President Charlie Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com.
This is Rich Dad Sales Advisor Blair Singer. Listen to Get Rich Education with Keith Weinhold, and above all, don't quit your daydream.
Today's guest is the Chief Credit Officer of First Foundation Bank. You can find them on the NASDAQ at FFWM. He is also the founder and CEO of Black Crown Incorporated, a disruptive collective that handles home purchases and a real estate brokerage for high net worth individuals. And I know that he also deals with some celebrity clients. He's an attorney based in the LA and Orange County area, out to make financial literacy accessible to all. You might have seen him featured in places like Yahoo Finance and New York Weekly. Welcome to Get Rich Education, Chris Naghibi.
Wow, that was a wonderful introduction. Thank you. I sincerely appreciate you having me on.
You're like, how am I going to live up to that? But watch, you will.
Impossible. Yeah.
Well, Chris, we've been in this environment where property prices have run up so far, so fast, 26% year over year now, depending on how you slice it, for the median home sale price in the United States. More of these offers are coming in all cash. So a lot of prospective buyers that want to get a loan, especially, are wondering, what does this do to appraisals? And how is that putting pressure on appraisals, especially when more people are coming in with all cash offers? So tell us more about that appraisal environment in this rapidly appreciating housing market that we're in.
It's been kind of a fascinating study of economics, frankly, because we're in this unprecedented, uncharted territory in the economy where, typically speaking, from 1929 until now, you've seen recessionary economies last about 7 to 10 years. And then you have a prosperous economy for another 7 to 10 years. Well, in this particular economic cycle, whatever you want to call it or describe it as, we've been in it for 13 years now, almost 14 years. We are now seeing things that are really unprecedented. So we had this economic stimulus as a result of the pandemic. And there was all this eviction moratorium. People were worried about investment properties. How is this going to impact the world? And early reports said that tenants were paying a lot less of a rate than they had been prior to the eviction moratoriums in the pandemic. And they said, oh my gosh, well, if you own a property, it's an investment property, your main source of value derived from that property is the income. That's why banks underwrite commercial multifamily properties, debt service coverage ratio.
Yeah.
The income matters. So what we found, though, is although people weren't paying about 70% on average per property at the first of the month when payments were due, they were actually still getting over a 90% collection rate through the month. So people were just slow paying. There wasn't as much of an impact as we thought. And then we started to see this rise of both institutional and individual investors coming in and buying everything in cash in a big way once that phobia or fear went away. When you think about the logic behind it, it's simple, right? It's historic low interest rates. You've got an environment that seems like it can withstand this appraisal kind of niche-y, like what's going to happen period. And values are holding and values are rising. The cash offers are holding up against all the things that we've seen, and they're really driving values up. And it used to be you come with an all cash offer and you would get a discount. That's not really happening so much anymore, right? What we're getting is you're getting a property, but you're getting the opportunity to buy it. Whereas a traditional, conventionally financed individual for whether that's a multifamily commercial property or a single family property, they're losing out to the cash guys. It's an interesting conundrum, but right now what it's doing is propping the values up and keeping those values in real estate rising in an environment where you would think that all the other outside metrics and indicators would say that it suggests a slowdown, and it's not. It's a fascinating case study for the strength of certain property types.
More than half of homes sold above asking price. So therefore, if you bid just the asking price, you're finishing somewhere in the bottom half. What has that done to the appraisal environment?
I think the appraisers are really challenged. The appraisers are looking at the metrics, and the market is moving so fast. I mean, when you think about that in the span of several months or several quarters, that's driving prices up and up and up and up continuously. That's not just a static snapshot of a singular month. So a property that just sold in my neighborhood is going to use comps from a couple months ago. Well, that property is going to, in turn, when it sells, use comps from a couple months later, and then so on and so forth. So it's having this progressive, real high trajectory path. And when you're talking about north of 20% property increases in some areas in a single year, that is, name a better investment, frankly, and name a set of circumstances where that can happen as rapidly, but yet still have the underlying collateral comfort that you get in real estate. It's really fascinating. So appraisers are really struggling right now because you have so many properties being sold at a high dollar amount. They're getting pressure to seeing this dollar per square foot in the single family world. That's really getting to a point where they're starting to question their comfort level with the market. And everyone's worried about, well, what next? But you look at Moody's, you look at CoStar, you look at Reese, and these are the data sources that these appraisers are using. They're going to go out to the comps. They're going to go out and do these things. They're all showing these increases year over year over year, and they're hesitant, but values are coming in, and they're coming in at appraised value over and over and over again. The shocking thing, though, is that you have so many consumers and institutional buyers in the market that are willing to pay over market. And those over market bids, we all know it. You wind up paying that delta between the appraised value and your loan amount and frankly, the purchase price. And you wind up paying a big dollar amount out of pocket. consumers are willing to spend it. And in aggregate, that just drives values up over and over and over again.
Yeah, a lot of people don't think about how that appraisal issue makes it even more challenging for the first-time homebuyer that's already seeing affordability get out of reach for them. And then if an appraisal comes in lower than the offer price and the prospective buyer needs to make up that gap, that makes it even more challenging for that first-time homebuyer.
Oh, the liquidity requirement's insane now if you're a first-time homebuyer. I read on the National Association of Realtors website a little while back that and on average, 8 offers before you get an accepted offer. That's a crazy number of offers and a kind of a mental exercise in torture for a first-time home buyer, because you think of first-time home buyers as having the bare minimum about money to put down, right? And whether you're putting 3% down or 20% down, I always advise 20, but you're putting that down. Well, now you need that plus the delta between your appraised value and your purchase price. You're putting this immense liquidity strain on first-time home buyers, or even maybe second-time home buyers that don't have that much equity built up in their home. This is a crazy market to be a seller because you can sell fast, but it's an insane market to be a buyer because it's almost impossible to get a good deal in this market.
Now, among those still qualifying for loans to buy property, whether that's their personal residence or whether it's a lot of our listeners who want to qualify for an 80% loan for a non-owner occupied income property, they still need to be attentive to some of those more conventional measures that we frankly haven't talked about on the show for a while here, Chris, like one's credit score and DTI and reserves. And of course, these are dynamic measures. I just happen to know, for example, Chris, we talk on the show a lot about inflation, the inflationary pressures that all this currency creation is creating, but there's also what I see as credit score inflation. In fact, I recently read that the typical credit score for mortgage borrowers in the second half of last year was 786, a record high. I think of that as credit score inflation.
That's 100% accurate. And there are so many interesting and fascinating factors. And for all those who don't geek out on credit, tune out because this is going to be hard for you because I love this stuff. And it's shocking to me. We've got a lot of things that we use for our baseline in the banking system that are old. Frankly, the way we conduct ourselves when it comes to real estate, title, escrow, those are 100-year-old traditional methodologies, right? But the credit score algorithm is almost as old as all of that. It's about 50 plus years old. And the baseline concept that they gave you in a credit score was your past behavior is an indicative of your future credit risk. If Tom and Jane own, this property and have had this debt and they've paid it all current, they likely are to do so going forward. So they're perceived to be a good credit risk and represented by a score. Except human behavior doesn't really operate that way anymore. Think about this. A lot of the Gen Z, the millennials, even in some cases, they're using Airbnb or they're renting apartments and they're trying to use their cash liquidity for different types of investments. Obviously, the most common right now, cryptocurrency. And they're thinking to themselves, well, I could go buy a house and make 20%, but if I buy Doge or Bitcoin or whatever your crypto of choice may be, can I make 40%? Can I make 50%? Plus, we don't teach these people financial literacy in school, and we don't have that same familial unit that we once had. So they don't learn about the credit score metrics. So people are using alternative ways to invest in structure that aren't necessarily as powerful for the credit score system. So if you have a credit card and you paid it on time, and you've got a car loan and you paid that on time, you generally have a really good credit score. Whereas somebody before that may have had several credit cards, may have had a mortgage, may have had a little bit more outstanding debt, and that impacts the algorithm differently. There's been a very good argument as of late that the usage of AI and outside metrics in addition to your financial metrics might actually give you a better forward indication of someone's credit risk than a historic look backward based on traditional metrics. At the bank, we don't spend a whole lot of time focusing solely on credit score. It's a factor in making a decision, but it's not a unilateral reason to exclude somebody. And I know that big box agency lenders, your Wells, your Chase, your B of A, they tend to focus on these narrow bands, right? If you have a 620 to 680 and 680 to 720, and that's great for the agency world where you're trying to sell off a homogeneous product in the secondary market. But community banks have the ability to, in regional and super regional banks for that matter, who don't sell into the secondary market, who portfolio their loans, they have the ability to be a little bit more malleable as it relates to those numbers. And while a 500 FICO is bad and an 800 FICO is good, I can tell you that there are other indications of strength that a lot of the investors don't really look to with the same degree of confidence as they should. Your liquidity position, your net worth, your experience in real estate, those things really matter.
Yeah. But we're talking about things that aren't measured by a credit score. And yeah, you bring up something really interesting, Chris. You touched on the fact that basically society changes. If you're a young urban professional, you're 26 years old that lives in Manhattan or San Francisco, you're not going to buy a home probably. You're going to have an apartment, so you're not going to have a mortgage loan reporting to your FICO score, or you're less likely to own a car, so you're not going to have a car loan, and that affects your mix of credit types, which is about 10% of the FICO score. Then there's a gig economy and how that all factors into a credit score. So yeah, some of these other modeling techniques like you're talking about could take greater importance than the old FICO score.
They certainly could. And there's a number of things like a firm where you can have a point of sale acquisition that actually don't report into your credit bureaus. They don't go to Experian, Equifax, or TransUnion. They're an installment loan that's a micro loan, and you pay it back over time. And unless there's an event of default, there's no reason for them to even report to a credit score. Another cultural thing that I see a lot of people spend a lot of time using their debit card, like a credit card. It has a Visa logo on it. It looks like a credit card. And that's a totally reasonable assumption for someone to get out of school and think that I can use this. I have cash. I've got no reason to really use credit cards. I have the money here. So what does that do over time? It limits your trade lines. And all these things, all these behavioral changes that we're seeing in society have shifted to contribute to this credit score inflation, because the algorithm is now looking at your maximum available credit. Let's say you have one or two credit cards, but you don't use it because you use that debit card. And what happens over time? You wind up in a situation where your credit score looks great, but you haven't really used a whole lot of credit. You might pay your gym membership on it only, and that's it.
And to bring in the relevance here for the beginning listener, generally you want to have a higher credit score because it is going to give you a lower mortgage interest rate. That's a big part of the motivation here.
Yeah, you do. And the interest rate is something that people underestimate. They think the difference between one number and another number is innocuous. But over time, over your amortization, the difference between great investors and okay investors is understanding their rates and being on top of them. The piece of advice that I give to both the new young generation and the seasoned investor is the difference in your rates and understanding the amortized cost over time and your cash flow, understanding how to use leverage as a weapon and really use it to build your portfolio is critical to your success. And that starts with understanding your rates and where your overall financial picture is. If you have a 4.5% rate in this economy, you better understand why. And you better understand if there's a cost benefit analysis that's done for you to figure out whether that should be a lower rate and if you can get it in this economy. And if you can, you should, because it's going to increase your cash flow and lower the amount of payments that you're going to make on interest over time.
What are some of the mistakes that you see when people try to improve their credit score, Chris, today? Some of the common pitfalls that one makes. There are all sorts of credit repair services that are out there, for example, and then there are mistakes that people make when they take things into their own hands, too.
There are a lot of old school traditional norms that I think that we all believe as a society might be a good thing, they inherently sound simple, but they actually don't help you. I'm not a huge fan of credit repair agencies, not because there's not a place and time for them. I'm sure there are, and I've got a number of circumstances with which that could be a totally acceptable or reasonable practice. But what I tell people is you should have enough ownership and knowledge of your credit and of credit in general to be able to make those moves and decisions on your own. Consolidating debt is okay if you do it without paying less than you owe. If you go to a creditor and you try to negotiate down your payment, that actually shows up as paying less than owed on your credit report and does have a material impact. By far and away, one of the most common things that I see, and I see this from every age group and demographic, is you've decided to be responsible with your credit. You've decided, I'm going to pay down all my debt and I'm going to cut these credit cards up and I'm going to close them and throw them away. Well, getting rid of your trade lines and actually removing them does impact your credit in a negative way. You've now removed a credit available amount to you, and your overall credit available to you on your credit report goes down. And from a mathematical standpoint, that actually lowers your credit score.
We're talking about the utilization ratio there, right?
Utilization ratio, exactly. And because the number of trade lines and how long those trade lines have been in your history also matter, it impacts the history of your credit from going back into that algorithm as well. So you have to think about things strategically. If you don't have a payment on a credit card, and you don't have an annual obligation, then generally speaking, don't close the trade line until you know you're in a period where you won't be utilizing your credit for at least 6 months to a year. So if you're not planning to buy a house for 6 months, that's fine. If you're planning to buy a house in the next couple of months, you want to keep your credit score as high as you can. Don't close that trade line right away. It might be worth it for you to pay a small annual fee in order to keep it open for a little bit longer. The credit world is such an interesting thing because people are brought up with the idea in this kind of sensationalism that credit is bad. They shy away from asking so many of these questions. And that is the single greatest mistake that I see consumers make. If you're unsure about something, a step that you might be taking with your credit, spend the time to Google it, research it, find somebody that can help you. Because believe it or not, the things that we think are normal, that would be a great, smart, prudent financial decision, that's not what the algorithm's for. The algorithm's only there to say, hey, has this person used credit? Well, do they have a lot of it, and how long have they had it? So getting rid of things and changing things in that equation may actually hurt you more than you realize.
You said it, spend the time to learn. It's not necessarily spend the money and close down the account, because that might hurt your utilization ratio, which is the ratio between the amount that you currently owe divided by your credit limit.
Exactly. That ratio is used by your underwriters, and they actually recreate that ratio. And when you talk about your front end and back end ratio, and it's required by agency guidelines and lenders, right? Your front end ratio, essentially your mortgage payment and your income compared to one another. And I always tell people that they should look up that ratio and figure out what their ratio is for themselves. And the back end is essentially that with all of your debt obligations. I'm oversimplifying it because it doesn't need to be complicated, and I think that lenders tend to make it complicated. The lender will look at that information to make sure that you qualify for a loan if you're going to buy a place, right? So your FICO score is only one part of it, but your trade lines are individually analyzed and used against your income to figure out how much free cash flow you have, which is why you see sophisticated real estate investors spend so much time obsessing on their cash flow. It's not because they just inherently want more money. It's because they want to increase that number over time, which increases their buying power and their ability to get leverage.
That's a great point. That can definitely affect the next purchase. Chris, when we talk about the next purchase and qualification criteria for getting another income property, often one gets hung up on the DTI, one's personal debt to income ratio, the total sum of their monthly debts divided by their monthly income. Oftentimes that number can be up to 43% or 50%, depending on the loan type or really the era that you're in or so on. One common question that people have about the debt to income ratio when it comes to qualifying for more property is, will that ratio be affected when I keep on buying investment properties? Am I still going to be able to get more loans to buy since I'm going to owe more? So can you tell us more about how one long-term can structure their debt to income ratio in order to qualify for more income property over time?
This is an interesting question because now more than ever, I've seen a lot of online gurus and people telling you about how you can buy this real estate and you keep buying more. You can get Airbnb properties. And there's a big asterisk there. And you kind of hit the nail right on the head. To structure your DTI, you have to plan to structure your income in such a way that you can continue to buy. And it's not just as simple as I bought a property, great, I've got more cash flow, I'm going to go get another loan. The lenders are going to look to your W-2 wages. And you as an individual only make so much money. And if your W-2 wages can qualify for your single family residence, your primary owner occupied property, that's well and great. But can you qualify for another property? And let's say maybe you have some great cash flow. Maybe you can qualify for a second home or a vacation home, or maybe it's just a rental property for you. But at some point in time, every real estate investor runs out of that W-2 income, if you have it. And then you have to start relying on the cash flow that's coming in from your rental properties. Except that doesn't show up on your tax return until the end of the year, and it won't show up for a full year until you've had that property on your tax returns for a full year. Some lenders are more willing to look at your current rents in place and verify that you're on title and do a little bit more analytical thought around that. But traditional agency lenders typically won't look at cash flow to give you that credit for your income ratios until such time as it's been on your tax return. So if you tell them I just bought a property this year, they're unlikely to give you another loan, which includes that additional cash flow. And why is cash flow so important? Because as you noted, the top portion of that ratio is your cash flow to debt obligations. And if your debt has gone up because now you have an additional mortgage on your credit report and your income, your cash flow coming from that property, that net difference between your mortgage payment and the money you're bringing in, if that money hasn't shown up on your tax return yet, then when they pull your credit report, they're going to see that additional mortgage and they're going to say, this person can't afford this property. So what I tell people, if you're really going to get into the real estate game and you're really going to spend the time to be strategic about how you acquire properties, you have to understand that maximizing your income and being able to represent it to a bank in a clear and concise way is critical to you continuing to get financing over time.
A lot of it comes down to being strategic and having good organizational habits.
Yeah, I mean, some simple tips that I use myself and I advise clients: keep an Excel sheet of your own properties. On that Excel sheet, it should have your property's address, who your insurer is, who your lender is, and you should have your mortgage payment on it. You should have your rental income on it, and you should know how much free cash flow you're getting. And then every time you have an expense, you should log it into that Excel sheet. And there are several different variants available online, and there's several different opinions on how that should look and be presented. But that document, having that in a living format that you can continually use and monitor over time, you can actually print that out and hand that off to a lender to help their underwriting process understand your financial picture. And simple steps like that make working with you as a consumer so much easier. It makes them have an easier time giving you a credit decision and stops them from digging into things where you give them a clear, concise roadmap to your financial picture.
I love how you laid that out, Chris. And yes, I personally use a Microsoft Excel spreadsheet. That way I build the formulas so I know where the numbers are coming from. I understand my financial picture well. I have a number of criteria on my Microsoft Excel spreadsheet, which is a list and a portfolio of my rental properties, a number that you mentioned, including other ones that mean a lot to me, like my leverage ratio, so that I keep that high and healthy and some other things. But yeah, lenders have appreciated getting that sheet because they understand my financial picture an awful lot better. Chris, is there anything else in today's economy that someone needs to know with qualifying for a property? It seems like the reserve requirements are one area that has not necessarily become any more stringent. Is there anything you have with respect to reserve requirements or anything else someone really needs to know for qualifying for a mortgage loan today?
There's a couple cheat codes that I like to tell people about. And some of these run afoul of traditional logic. And for that, I'll say just give it a thought and sleep on it, and maybe it'll make more sense with time. A lot of people tell me they don't have a relationship with the bank, and they don't, when they're starting to get into becoming a real estate investor, or they're starting to really look at buying real estate, they don't think about, you know what, I have a checking account. I have an account somewhere that I use for my primary life, or that I have money going to and coming out of. Vis-a-vis that relationship, you already have someone that you should be reaching out to as your primary point of contact to get a loan. I'm a huge fan of community banks, of regional banks, of banks where you can walk in and talk to somebody who you know. And the reason why I say that is relationships are the truest form of currency. It's who you know that really matters. And when it comes to real estate investing and building your portfolio and some of the changing landscape of real estate, the easiest way to find out how you can qualify for things, rather than applying to Wells Fargo, Chase, and B of A, nothing wrong with them, but they're just a bigger bank, bigger institution. You can literally call your lender and say, hey, what's changed? What's going on? And they will let you know the landscape because they're steeped in it, and you have direct contact to somebody who's doing it on a daily basis. And you as an investor, you as a property owner, that relationship is more invaluable than you realize. I will say some of the things that have been interesting kind of changes in the way we look at credits, especially single family and investor stuff, is we're spending a lot more time looking at what properties are going to be utilized as Airbnb properties. Those are traditionally service-based businesses, and they operate more like hospitality than they do like a traditional single-family rental. If you think about it in the shoes of a lender, in a worst-case event scenario of default, we have to take that property back. One of those, the hospitality property, requires a lot more management, oversight, and due diligence. And sure, there are third-party companies you can hire to do that, but to this day, banks still look at that as an additional level of risk or complexity. I'm not saying that that's a bad business. As a matter of fact, it's very lucrative under some circumstances. Me personally, I invest in long-term tenancy, long-term rentals. I can understand the draw, but just know that that comes with a healthy degree of skepticism. And if you're going to operate your properties as an Airbnb, banks usually struggle a little bit more, especially the traditional ones. But having a relationship with a community bank gives you the opportunity to at least explain it and allow them to understand your model and have conversations about cash flow over time. Reserve requirements have actually not gone up, but what I will say in the landscape that we're looking at is that your reserve will be after whatever it is you put down to buy the property. And in this market, that's been a lot of money. If you're paying over market, so your lender's going to give you a pre-approval or pre-qualification letter, whatever they call it, based on you buying a property at X dollar amount. Except that doesn't contemplate the liquidity difference between the purchase price and the appraised value. If that appraisal comes in low, and let's say it's $100,000 low, your liquidity is going to go down significantly more than you may have anticipated in those initial conversations. It's very, very, very critical that you plan ahead to spend a little bit more than the appraised value in this environment, which means you will ultimately have to have more reserves prior to buying a property. It's just not your bank that's going to be requiring it in the form of traditional reserves.
That's a great way to think of it. That's something we really need to pay attention to in this heightened appreciation environment. Well, Chris, you help so many people on the brokerage side and on the lending side and with guidance on qualifying for a loan. If someone wants to learn more about you and what you do, what's the best way for them to do that?
The best way to do that is follow me on any of the socials that we offer. TikTok and Instagram happen to be my two favorites du jour. We're also on YouTube, where we do a little bit more of a longer term format. And the idea is we're providing free financial literacy. We're not asking for anything. We're not selling anything. We just want to help people be the best that they can be and give good old fashioned solid advice. And it's a simple handle. My name, it's at Chris Naghibi at TikTok and Instagram.
Chris Naghibi's name is spelled Naghibi. And when you think about it, it's more important than ever to know how to qualify for a loan. And that is because the reward is a historically low interest rate. Chris, thanks so much for coming onto the show.
Thank you for having me. It's been a pleasure.
Yeah, good stuff on more of the technical execution of how everyday people can position themselves for good debt, getting the best debt that you can, and then embracing it. Credit scoring and debt-to-income ratio management are really something for you to get educated on because it's often counterintuitive. You can still get a good real estate deal, even in today's appreciated environment, because GRE turnkey sellers, they like investors and they will sell property to you for less than they will a retail owner-occupant, less than someone that's buying a primary residence, because that group of people, they only buy one time and they only buy 8 years or so. Well, turnkey sellers often sell to investors like you for less money because you're less picky than if it were going to be the home that you were living in yourself. You already have a better idea of what you want. And then once you buy one property with them, you are likely to buy more. That's why property sellers love dealing with investors. By the way, I talked about having my own Microsoft Excel spreadsheets for my property portfolio there. I actually use Google Drive, but they effectively do the same thing. One big lesson from today's show is that the wealthiest people have the most debt. Thanks to Chris Naghibi today. Coming up on the show here soon, it's the return of Rich Dad tax advisor Tom Wheelwright. And then later, next month, it is the 50th anniversary of when President Richard Nixon removed the last semblance of the dollar from the gold standard. That is going to be a special show. For our operations lead here, Andrea Newbern, sound engineer Bidron Jampo, content manager Matthew Blunt, web designer Nikon Roy, my name's Keith Weinhold, and I am grateful for your listenership. So many of you have told me that you've listened to every single weekly episode for between 6 and 7 years here now. I can't even express how much that means to me. Thanks for being here, but you weren't here for me. You were here for you. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.